Name is welcome back to another episode. Today I have it's gonna be a this may be an extra long video. I'm just letting y'all know that right now. It may be extra long. Um, so I compiled here together possible homes to place our cash. Right, we're making money. That's good. Right, which which place is the best place to put our money so where it's optimal, it grows, and it's tax purposes, benefits for that too. We can, tax write off purposes and stuff like that. So, in this episode, why do I keep saying that? I'm just gonna go right into it. All right, just optimizing your guys' cash flow. All right. All right. So there's five homes to flow in your cash. Okay, you got the banks, stock market, retirement accounts, real estate, life insurance. All right, and I'm gonna just determine which of these is a good place to put my cash. And over here on the left side, where you just saw the liquidity, safety of principal, tax deductible, tax advantage, and growth, pretty much I'm gonna just judge these different homes based off these core values. So, just to break down these different categories, liquidity, having access to my cash fast as possible. Like I mentioned in my earlier video, I use Coinbase. Okay, so like I use that for my crypto to flow my cash the variable way. I got liquidity. I can get that money out quickly by an app. Okay, safety of principle. Um, I will not lose my money, straight up. In this, when I put my money here, I won't lose it at all. It's safe. Third and fourth, tax deductible, tax advantage, tax write off, or what? Okay, and then you got the growth. Is my cash outpacing inflation? Cause stuff keeps going up. If I'm putting my cash here, I still should be able to buy gas, milk, groceries, and not trip about the high prices, right? 20 years from now, I know for a fact gas will not be the same price, milk will not be the same price. The cash, my cash got to keep up with whatever's going up. We living in abundance. The planet we're on is abundance. We living in abundance. So I'm gonna just be going line by line, starting with the banks, over to life insurance of these different homes you can place your money. So when we look at liquidity with the banks, you have liquidity there. Okay, you got ATMs, debit cards. You can get your money whenever you need that money. Now on over to stock markets, you got liquidity there. Okay, as I mentioned with the Coinbase app, Coinbase, I personally use Coinbase because it works like Cash App. Okay, I can literally if I need to get $20 out right now, I can just literally just click to get $20 out. Go to my ATM. I see it on my debit card. I see I can get it to that. I can get it out the bank right then and there. Any other exchanges? I'm not sure. I know like crypto.com. I don't know. That's what I use. Now over to these retirement accounts, 401ks, IRAs. Unless you're triggering that 59 and a half penalty, you don't really have liquidity in that money access right then and there. You do not have it. And over to real estate, there's no way you can just sell this house and just have liquid on that, sell that house right then and there that exact day. It takes a while stuff to go through before you can just get that cash that day. Now there might be some other instances where you can, but to my knowledge, not really, not happening. Then over here to life insurance, you actually have liquidity there. If you have a life insurance policy, if you have a life insurance policy, like you have a whole life policy, you have a term policy, or you have an index universal life policy, you're leveraging the IRC, the Internal Revenue Code 7702, which allows you to leverage that death benefit as a loan proceed for living benefits and whatnot. You can leverage that life insurance policy. Not a term, not a whole life, but like an index universal life policy, you can leverage that death benefit for building capital. Not I would say, but yeah, building capital, living purposes, retirement income. Just you can use it for a lot of good purposes. Okay, just know you can use it, and you can just call it up. The insurance company, just how you would do anything, and just get your money out as a loan, right? So I'm going down to the second row, safety of principle, right? Safety of principle. I'm not gonna lose money here. My money's safe. If I float my cash here, I know it's straight. In the banks, it's good. My money is backed by the FDIC for up to $250,000. My money is safe. I ain't even gonna say $250,000. That is $250,000. $250,000. There you go. Right? Immediately over into the stock market is no way. There's no way. I know it's safe over there. I know for a fact. I put my money in Coinbase, even in Bitcoin. Right? I see that thing go down. Guess where my money went? Down. But guess what? When it go up, it better go up twice as much. Because if it don't go up twice as much, I'm not gaining back what I lost. Right? Over to retirement accounts. Safety of principle. There's no safety of principle there. My 401k, I don't even have a 401k, y'all. Just being honest. I'm going to say this a little louder. I don't have a 401k. Okay? I don't do those things. All right? But I do know this. 401ks are tied to the stock market, okay? If you check my earlier videos, I spoke about retirement accounts. I spoke about IRAs, 401ks. I spoke about, even for life insurance, I spoke about index universal life policies. Check out those videos. I think I may leave a link up there for you guys to click and just check it out. But yes, that 401k, guys, is connected to the stock market. So whatever the stock market does, guess what happens to my retirement money that I've been saving here does? It starts going down. You know, it starts going down because it's tied to it. Right? Real estate. Absolutely no safety there. You got tenants that do all kinds of things. I can't guarantee that this property is not going to lose value. We can't guarantee those things. I can't. And when it comes to life insurance, it's life insurance. It's obvious. It's safety there. Insurance is like the backbone of the world. That's where most of these big businesses put their tier 1 assets. They put it in life insurance. If life insurance is like the last domino to fall in any economic governance. Just so you guys know. Now moving on down to these taxes, tax deductible. Okay. Everybody already know historically taxes in our country has been going up historically every year. That thing don't go down. That thing go up. And if I had a chance to be taxed now, taxed later, or taxed never, bro, I'm going to choose to tax and never. I never want to be taxed. You know? So so I'm just going to be looking at taxes. We're going to look at taxes from two different sides. All right, we're going to look at it from tax deduction, tax advantage. Tax deduction, when I put my money here, can I get a tax write-off? Can I have a tax write-off here? Is there a possibility I can get some tax write-offs here and have some tax savings? Right? Tax advantages, how the IRS is going to tax my money going here. Okay? So when it comes to the banks, y'all, we don't have any, tax write-offs from putting my money in that checkings account. When I get my check, direct deposit in that checkings account, ain't no tax deduction comes from that. We wish it was, though. We wish it was. Now, is there a tax advantage once the money's in like our CD or our checkings account or our savings account? Is there like from a tax perspective, there is no tax advantage perception from there neither. And when it comes to the stock market, am I reducing taxes from investing into Bitcoin, investing into crypto stock market? No. If anything, I'm paying what is called capital gain tax. Now, if you checked out my other video, make sure you check it out. I've spoken about capital gain taxes. If you placed $100 right now into the stock market, okay, and that thing goes up to $150, right? You have to pay what is called capital gain taxes on that $50 that you made when you pull that money out. And you get ready to file your taxes, you got to pay that. Okay? That's what that's called. That's what that's for. All right? Now over to these retirement accounts. You got a tax deduction. There's a plus side with there. We're putting your money in these qualified plans. Okay? Because let's say you make $100,000 a year. And you put $10,000 away in your 401k. Okay? So think about this. You make $100,000 a year, and you take $10,000 of that. You take $10,000 and you put it in your 401k. So that $10,000, that's tax deferred for you. So on paper, when you file your stuff on paper, your paperwork, you file that you've made $90K that year, which could possibly lower you from a lower to a lower tax bracket, therefore lowering your taxes. Okay? So that's why I put that plus there for that tax deduction. Now, I want you guys to know we have these 401ks, we put our money in there so they can grow tax deferred out of these traditional retirement accounts, okay, to grow tax deferred to be taxed in the future. When taxes are, like I just said earlier, taxes bitches going up, up, and up when taxes are what? Higher. And who is that going to be? Who is that benefiting? It's not benefiting us. So why do we do it? It's because we're not educated on taxes when it comes to, getting to abundance. I'm not even going to just say wealth. I'm saying getting to abundance. It never runs out. So, because, 401ks were not designed as retirement vehicles. Okay, it was only designed as a tax deduction for like wealthy executives in the 80s. But crazy enough, we all use 401ks now. Even though most of us aren't wealthy executives. Okay. Now, when it comes to tax advantage, there also can be a plus. If you work for a business, okay, if you work for a company, your employer offers a Roth 401k, or you have a Roth IRA or a Roth, that's someone that's saying, I don't want to be taxed in the future. They're going up. Tax me today. So they choose to opt out taxes in the future for taxes now in the Roth option. So a Roth is a tax advantage. Okay. Now over to real estate. When it comes to real estate, there is a tax write-off. There is no tax write-off or deduction. Now some people may say yes, because they think if they buy a house, it's a write-off. It's not. Once you own that home, the interest that is in that real estate home is a tax write-off. The interest is, okay, we write off that interest. When that interest be going up, we write off that interest. So we won't put that plus there for tax advantage. And when it comes to life insurance, there's a plus for that too, because let's say you have, remember I spoke about earlier, we have a term, whole life, and we have index universal life. So with index universal life policies, they can be used for building capital. And you can also use whole life policies, and I've spoken about them earlier in some of my other videos. I'm going to leave them in the description below for your infinite banking. Like you have a payroll account, we can diversify, and we can divert that money that's going towards a payroll account in a checkings or a savings account, and we can redirect that going to like a life insurance policy and use the business expenses or use all, uh, the loan costs. We can use the loan costs as a tax write off for business expenses. So I'm gonna put that video. If that was like something that kind of perked up you guys' ears, I'm gonna put a description in the. Not a description. I'm gonna put the link to that video, um, in the description so you guys can check that out. Okay. Now, there's also a plus side for the tax advantage. I said that earlier under the what was this? Yeah, under the IRC Internal Revenue Code 7702. You can in 7702 101A 72E. You can accumulate money tax free in these life insurance policies. Right? You can tax free. You can have them income tax free. Um, income, retirement income coming in, because loan proceeds. Now, I want you guys to write this down because this was something that I had to write down and I had to learn too as well. I've just been reading this book called The Laser Fund. If you guys haven't heard of this book called The Laser Fund, it's a phenomenal book. I might have to put it right here. Yeah, it's called The Laser Fund. And what was I saying? Um, about the tax advantage with it. Yes, these loan proceeds, guys, they aren't deemed as earned income or anything like that. Okay, they're totally tax free, right? So make sure you guys check that out as well. I'm gonna leave a book. I'm gonna leave the link to that book in the description below, so you guys can check that out. Because I've been reading up on these life insurance as well. I actually read a lot of things about them. Last thing we got here is the growth. Okay, is my money outpacing inflation? Like I said earlier, right? At a rate of at least 3% or more. Okay, so with the banks, absolutely not. I'm gonna just say that right now. My money, if I'm just leaving my money in the bank, my money is not outpacing inflation. It's not outgrowing anything. It's just sitting there. Gas prices go up, but I still have the same, $20 or whatever, probably even more in that, in that checking account or that savings account. It wouldn't be, enough. I remember when I was a kid, gas was about $1.75, and now it has reached almost to $10 to $5. Like, come on, stuff is going up. With these stock markets, absolutely, I can see growth in my money. I can see it. And if I can see growth here in the stock market, I can see growth in my retirement account. If I can see growth in my retirement account, I can see growth in real estate. Real estate can appreciate, and it can do me well. And I know it does some people. I know it does some people well that's in the real estate business, as well for life insurance, because your money is tied to the growth of an index, of your chosen index. You can choose. It doesn't have to be the S&P 500. It can be the Dow Jones. It could be the Barclays. You can choose which index you want to diversify for your greater outcome. So that's why there's a plus here. So even just scoring everything up, life insurance at the end, well, I got a 4 out of 5. It's a 5 out of 5. But yeah, that was optimizing your cash flow. The different the 5 homes of money where you can place your money: banks, stock market, retirement accounts, real estate, and life insurance. Now, I'm not saying that, hey, you don't put all your eggs in one basket, but there are options, and it's always good that we know our options and what's out there. So be sure to hit that like button. Be sure to subscribe and to follow along the channel. and we can just keep going in an even deeper dive into cash flow and life insurance, because there's something about that life insurance that I keep hearing. Something about that life insurance, and so I'll just be revealing more and more, deep diving into these life insurance, into dynamic banking, utilizing lines of credit with dynamic banking, infinite banking, right? If you guys remember, diverting your cash flow into a max funded life insurance policy for your payroll expenses, for your payroll accounts, for your profit sharing accounts, for your employee bonuses accounts, various different things for business owners, right? So we'll just be going into a deeper dive more than that. Thank you guys for tuning in today. Check back again for another episode. I will eventually name these episodes. I don't know. But yes, thank you guys for watching, and have a good evening.